Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Calix Inc. Annual Report. Calix Inc. offers a wide range of businesses and services to broadband service providers, BSPs, across various regions. The company's cloud and software platforms enable BSPs to provide various services, including mobile applications such as CommandIQ for residents and CommandWorks for businesses. The company provides several managed services under its Smart Life platform, which includes Smart Home, Smart Town, and Smart Biz. These services enhance the connected experience of subscribers in their homes with features like Wi-Fi, advanced content control, network security, and social media monitoring. The Smart Town service reimagines community Wi-Fi as a secure and managed experience across a BSPS footprint. In addition to its cloud and software platforms, Calix offers Wi-Fi systems under the GigaSpire and GigaPro brands for residential and business subscribers. These systems are designed to be ready for deployment as a complete subscriber experience solution. The company provides its products through both direct sales force and resellers. And the stock price of Calix Inc. has experienced a significant increase in the past year due to several key announcements and financial performance indicators. One major catalyst was the company's robust Q4 2025 earnings and strong 2025 performance, which saw record revenue of $272 million for the fourth quarter, a 32% year-over-year increase. This marked a return to profitability with a net income of $17.9 million for the year, contrasting with a loss in 2024. Another significant factor was Calix's optimistic Cone 2026 revenue guidance and share repurchase program expansion. The company also demonstrated confidence in its future by increasing its stock repurchase authorization by an additional $125 million. Furthermore, the launch of Calix One, an AI-native platform designed to unify appliances, cloud software, AI-powered agents, and managed services, was a major positive development. The strategic pivot towards advanced AI solutions for service providers has been well received by investors, with one-third of customers already on the platform, and a full transition expected by the end of March 2026. Additionally, product announcements in February 2026, such as Home Office IQ and enhanced Calix engagement cloud capabilities, further showcase the company's innovation and potential for revenue growth. The BEAD program opportunity, which could generate $1 billion to $1.5 billion in revenue, has also provided a long-term growth outlook for the company. Overall, these events have created significant positive momentum for Calix Inc. stock during the past year, driven by strong financial performance and strategic innovation. Calix Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Calix Inc. trades at a higher price-to-earnings ratio of 214 times and a higher price-to-book ratio of 4.32 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company over several years can be attributed to several major Firstly, the increase in sales by 25% from $453.6 million in 2024 to $568.3 million in 2025 was a significant contributor to revenue growth. Additionally, appliance revenue grew by 19%, while software and service revenue increased by 27%. These increases in revenue were also supported by an increase in deferred revenue of $2.7 million. On the other hand, there were some decline drivers that affected the company's revenue. Decreased accounts receivable, inventory, and supplier deposits all contributed to a reduction in revenue. However, it is worth noting that these declines were relatively small compared to the increases in sales and revenue from other sources. In terms of geographic breakdown, the United States was a significant contributor to revenue growth, with an increase from $764,593,000 in 2024 to $934,829,000 in 2025. In contrast, Europe, Americas excluding US, and rest of world all experienced decreases in revenue over the same period. Overall, while there were some decline drivers, the company's revenue growth was driven primarily by increased sales, appliance revenue growth, and software and service revenue growth. The net income and profit margins of the company underwent significant changes between 2022-2025. In 2022-2023, the net income increased by $29,325,000, marking a positive trend. However, this growth was short-lived, as the net income decreased to -$29,747,000 in 2023-2024, resulting in a loss. Fortunately, the company bounced back in 2024-2025 with a net income of $17,884,000. The profit margins also experienced fluctuations during this period. The gross margin increased from 49.85% in 2023 to 54.63% in 2024, and further rose to 56.83% in 2025. Conversely, the operating income margin declined from 2.47% in 2023 to -5.2% in 2024, before recovering to 2.1% in 2025. The reasons behind these changes can be attributed to several factors. The increase in gross margin is largely due to the continued adoption of platform, cloud, and managed services. Additionally, a decrease in sales and marketing expenses as a percentage of revenue contributed to the improvement in profit margins. These strategic decisions have helped the company recover from losses and achieve positive net income in 2024-2025. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the latest figures, net cash provided by operating activities reached $134,953,000 in 2025. This trend of positive operating cash flow has been consistent over the past 3 years, with each year showing an increase in net cash provided by operating activities. This achievement is a clear indication that the company's operations are generating sufficient funds to cover its expenses and investments, resulting in a positive operating cash flow. The consistency of this trend suggests that the company's financial management strategies are effective in optimizing its cash flows. The company's debt level has seen a notable increase from $41,000 between 2024 and 2025. This rise in debt is a significant change that warrants attention. However, the interest expenses have not shown any substantial changes during this period. The company's financial stability is further supported by its minimal exposure to fluctuations in interest rates due to its cash equivalents and marketable securities. The performance of various segments and regions in the industry has been mixed. On a positive note, emerging service providers, fiber overbuilders, and cable MSOs have shown strong performances. These groups have been able to capitalize on growing demand for high-speed internet services. In contrast, international markets have struggled, with China and India being particularly underperforming. Local markets outside the U.S. have also faced challenges, likely due to a combination of factors such as regulatory hurdles and economic uncertainty. Additionally, countries with strict environmental regulations and regions affected by climate change have experienced difficulties in their operations. It is worth noting that the performance of U.S. operations has not been specifically mentioned, suggesting that they may be performing at or near industry averages. Overall, while there are certainly areas of strength within the industry, there are also significant challenges facing certain segments and regions. Management statements about the company outlook or strategy convey a mix of caution and optimism. On one hand, they acknowledge uncertainty around future financial position, business strategy, market conditions, and economic performance. This uncertainty is compounded by risks such as cybersecurity threats and regulatory compliance issues. However, management remains committed to transforming service providers into customer experience providers, CXPS, that focus on delivering outstanding subscriber experiences. They see opportunities in broadband expansion in rural areas due to government programs and plan to expand into adjacent markets, offering cloud and managed services. This growth strategy is expected to be driven by investments in sales and marketing, as well as research and development expenses. Management also emphasizes the importance of investing in AI technologies and cybersecurity measures to mitigate risks and stay ahead of competitors. While there are significant challenges ahead, management's focus on transformation, expansion, and innovation suggests a commitment to long-term growth and success. The company's dividend policy is clear. It does not intend to pay dividends in the foreseeable future. In fact, the company has explicitly stated that it will not declare or pay a cash dividend and has even estimated its expected dividend yield to be zero. This suggests that shareholders can expect no returns through dividends. On the other hand, the company has been actively buying back shares. It has a common stock repurchase program in place, with a significant amount of funds available for share buybacks. In fact, as of December 31, 2025, the company had already repurchased over $148.7 million worth of common stock. This indicates that shareholders can expect returns through share buybacks rather than dividends. Concerns about inventory buildup and supply chain disruptions. The recent data suggests that there may be issues with inventory management and supply chain stability. One key indicator is the significant increase in finished goods inventory, which rose by $50.5 million from 2024 to 2025. This buildup of inventory could lead to excess costs and potential obsolescence. Furthermore, supplier deposits decreased by $48.7 million during the same period, indicating a possible strain on cash flow or a shift in procurement strategies. The mention of component lead times and purchase commitments as potential risks also raises concerns about supply chain reliability. Additionally, there are worries about receiving products from contract manufacturers and original design manufacturers due to potential stoppages or delays. These issues could have far-reaching consequences for businesses, including increased costs, reduced efficiency, and damage to reputation. That concludes the financial summary for Calix Inc. Feel free to comment below, and I will be happy to answer them when possible.